In this episode, we share a huge update for borrowers on the SAVE plan, and we finally tackle the newly created Repayment Assistance Plan. Let's get started. Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello, my name is Brenton Harrison of Escape Student Loan Debt and your host for the Escape Student Loan Debt podcast. I would ask that if you're listening or watching this episode today that you give me some grace in terms of the quality of the recording. In transparency, we had to take an unexpected trip up to some family members. So I am traveling without my equipment, and as a result, I am recording on my webcam today. I will be back by the time this episode is posted. I am one of those people who does not like telling people when I'm out of town while I'm out of town. But at the time of this recording, I was not in my home pseudo studio. So please give me some grace. We're going to start today's episode with something that I wasn't expecting to cover because I didn't know what was going to happen until yesterday. And that is the Department of Education announced that starting August 1st, they are going to begin accruing interest for people on the SAVE plan who are currently in forbearance. So the forbearance itself is not ending August 1st, but even if you are in forbearance, interest is going to start accruing. This is a big development, especially for people who have larger balances with federal student loans, who have had their loans in SAVE forbearance for a significant period of time, because on the negative side, while you were in administrative forbearance, you weren't getting any credit towards income-driven repayment plan forgiveness or public service loan forgiveness. On the positive side, you at least knew that your loan balance wasn't going to increase because they were waiving any interest that was accruing on your loan. With that changing, this is kind of the process that I said was going to start last week, where I said, hey, if you're on SAVE plan forbearance, eventually they're going to kick you off that plan. It's probably going to be sooner than later. To me, this is the first step of trying to kind of force you or nudge you off of the plan, although you're not required to leave forbearance. And here's why. To me, even in the release, they're trying to push you towards the income-based repayment plan, even though they know that there are other plans that will be available up to 2028. They are trying to get as many people on that income-based repayment plan as possible because that's one of the only two plans that will exist beyond 2028, the other being the repayment assistance plan that we're here to talk about today. So to be clear, if you're on the SAVE forbearance and even though your loan balance is increasing, you are benefiting more from not having to make a payment, and you are still eligible to stay on SAVE. If that's the best thing for you to do financially, then I would, just stick with that strategy. Because if you're saying, the interest is growing, but I'm avoiding a $500 or $1,000 payment, that may still be the best strategy for you. If you're saying, I don't like the idea of interest accruing, keep in mind, you can still make payments on your plan while it's on SAVE. But I would argue that if you're making a payment that's at least what your payment would be under pay as you earn or new income-based repayment or old income-based repayment, that you might benefit from putting yourself on one of those payment plans so that you're getting that payment credit towards income-driven repayment or public service loan forgiveness. So it definitely represents a change in strategy. I would say that if you're eligible for new income-based repayment plan, that's a no-brainer. If you can afford that payment, I would go ahead and switch onto new income-based repayment. If you're eligible for pay as you earn, but not new income-based repayment, I would still consider getting on pay as you earn, knowing that at some point in time that plan is going to go away, but you still might get some benefit until it does. If you're on old IBR and you can make the payments, it would really just be you're really, really wanting to get some credit towards forgiveness, because otherwise that payment is likely high enough that staying on SAVE, even in spite of interest accruing, may be a better option, at least for your budget. Because this is not all about federal student loans. It's about paying off your federal student loans while achieving other financial objectives. So that is the quick update as it relates to SAVE plan. Now let's get to the repayment assistance plan, which thankfully is, not a great plan in terms of what your payment will be, but it's a relatively straightforward plan in terms of describing it on this episode. As a reminder, if you are a new borrower, July 2026 or later, this will be the only option that you have for income-driven repayment plans. The same would be true if you need to consolidate your loans to be eligible and you don't do so by July 2026. This would be your only option. So if you're listening to this episode and you don't like this plan, you need to either consider not being a new borrower after July 2026 or if you need to consolidate to be eligible, to start that process now so you're not under the gun before that deadline. The current income driven repayment plan options, because the repayment assistance plan is not yet available, those plans are income contingent repayment, income based repayment, old and new, and pay as you earn. And even though the calculation is a little different, the principal elements of the other existing plans is that you take your adjusted gross income and you subtract a percentage of a number called your federal poverty level. And once you do that, it gives you something called your discretionary income. Now, but depending on the plan, you're going to pay a certain percentage of that discretionary income. But let's go to that formula and talk about how you have been able to strategize in the past to lower your payment. The first part is it takes your adjusted gross income, which means that you can use pre-tax deductions to lower that adjusted gross income. And if you do so, it would lower your loan payment. Pre-tax deductions are things like the amount you put into your pre-tax retirement accounts, like a 403b, a 401k, a 457 plan, an IRA. Other pre-tax deductions are things like contributions to a health savings account, a flex spending account, a dependent flex spending account. If you're an entrepreneur, half of your employment taxes are an above the line deduction that decreases your adjusted gross income. So if you could find a way to do as much of that as possible, that was one way to lower your payment under these existing plans, by lowering your adjusted gross income. Remember, the second part of that formula is subtracting a certain percentage of the federal poverty level. Federal poverty level is an amount of income based on the number of people in your household that the Department of Health and Human Services sets every year. And that is basically what determines whether you're eligible for certain social services. So, for easy math, let's say that a single person, their federal poverty level in 2025 is $10,000. Well, under this payment plan, you might be able to subtract 150% of your federal poverty level, or 225%, which is what they had initially put up for the SAVE plan. And if you're looking at that formula, you can see that while lowering your adjusted gross income was helpful, increasing your federal poverty level would also lower your discretionary income when it came time to calculate your payment. How do you increase your federal poverty level? Well, it's understanding the requirements, things that we've talked about in the past, where people would think, oh, I have to have my child before they're added to the number of my household, which would increase my federal poverty level. That's not actually the case. The regulations say that if you are pregnant with child and the child is due to be born in this calendar year, they already exist in terms of a number of your household for the federal poverty level. So you can call your loan servicer, let them know that you're pregnant or your spouse is pregnant. You can increase the number of people in your household, increase your federal poverty level, and as a result, lower your discretionary income and your loan payment. So those were the two different ways that you could strategize to lower your payment under this plan. Repayment assistance plan works very differently. There is no federal poverty level or discretionary income when it comes to calculating your payment under repayment assistance plan. It is just a calculation based on the number of kids that you have, or dependents, excuse me, and your adjusted gross income. So if you're looking on screen, we're going through the Escape Student Loan Debt Guide to Income Driven Repayment Plans. We're going to be covering this a lot and using it a lot in subsequent episodes. So if you have not already downloaded it, I would encourage you to do so by going to escapestudentloandebt.guide, and it will allow you to access this plan. You will see that we have added information for the repayment assistance plan. But in terms of the way they calculate payment, you'll see that instead of using a discretionary income, they are instead using a calculation of a certain percentage of your adjusted gross income. Now, what does that percentage end up being? Well, what they do is they look at the bracket of income that you have, and based on that bracket, they charge you a certain percent. What do I mean? If your adjusted gross income for the year is below $10,000, then you will have a minimum payment of $10 a month. This is a departure from the existing income driven repayment plans, where you can have a discretionary income that is so low that your payment is calculated at zero, and you would get credit towards forgiveness with a $0 payment. That changes under repayment assistance. If your adjusted gross income is below $10,000, you will pay $10 a month. Anything between $10,000 and $20,000 of adjusted gross income, you're going to pay 1% of your adjusted gross income on a yearly basis. Anything between 20 and 30,000, you pay 2%. Between 30 and 40, 3%. Between 40 and 50,000, 4%. Between 50 and 60,000, 6%. Between 70 and 80,000, 7%. Between 80 and 90,000, 8%. Between 90 and 100,000, 9%. And any individual or family with an adjusted gross income above $10,000 is going to pay 10% of their adjusted gross income per year towards their student loans. That is the calculation. It is a departure from discretionary income where federal poverty level was included. It's much more straightforward, but because you can't reduce your discretionary income by utilizing that federal poverty level, it actually makes it even more important that you utilize your pre-tax deductions that lower your adjusted gross income. So whereas there were two camps that you could use before, now being left with one, it makes things like contributing to your 401k, maxing out a health savings account or a flex spending account even more crucial, because this is now the only silo that you can use to reduce that payment. And if you want an example of what this might look like on paper, let's say that we have a family that earns $150,000 adjusted gross income. They have two kids, which means they are a family of four. We're going to assume they have a total student loan balance of, $200,000, and they're paying that back at 6% interest. You will see that we've also updated this calculator to include the repayment assistance plan for a calculation for this couple earning $150,000. Under the pay-as-you-earn plan or new IBR, they would pay $848 a month. Under old income-based repayment, they would pay $1,200 a month. Under repayment assistance plan, they would pay $1,150 a month. And this is something where I have seen in most cases the payment for repayment assistance plan come in a little higher than old income-based repayment, but there are some scenarios depending on family makeup and how far or close you are to that $100,000 of adjusted gross income, where the old income-based repayment plan is sometimes higher than repayment assistance. So there is not a guarantee, at least in terms of what you're paying on a monthly basis, that repayment assistance plan will be the worst plan if the only two for which you're eligible are repayment assistance and old income-based repayment. Now, it may not be the worst plan based on the payment itself, but you do have to have an understanding of how long you'll be paying these loans. Pay as you earn and new income-based repayment, they allow you to pay your loans for 20 years until any remaining balances are forgiven. Old income-based repayment, it's a 25-year repayment schedule. Repayment assistance plan is unfortunately a 30-year repayment schedule. So to me, that's the thing where it's like, man, I'll pay $100 a month more on IBR to pay for 5 years less as compared to repayment assistance plan. That said, there are some unique structures in terms of what would be forgiven at the end of that repayment period that you do need to be aware of. When you have old income-based repayment, and this is why you have to have like an idea of an individual strategy as compared to just assuming. Old income-based repayment has an interest subsidy for the first 3 years. And what an interest subsidy is a scenario where the government is covering some of your unpaid interest. So for example, if you had a $500 payment under this plan, but there was, $150 worth of interest that your payment didn't cover, well, an interest subsidy would help cover some of that unpaid interest for you in the past. Under old income-based repayment, that interest subsidy exists for 3 years. One of the reasons that people loved the SAVE plan so much is it was 100% interest subsidy, meaning that it did not matter how much interest was accruing and unpaid on your student loans. The government was going to cover all of it, meaning that there was no scenario where, like now, many people leave school and then 15 years later, they owe even more than when they left school because of that runaway student loan balance. The SAVE plan took away that possibility. Interestingly enough, the repayment assistance plan takes away that possibility as well. It is a 100% interest subsidy in all years. Now, there is a lesser known, lesser discussed benefit that I think is a reason it's lesser discussed, and that's what's called a principal reduction. So you have this unpaid interest, and essentially what this plan says, repayment assistance plan, is that if you are not reducing your principal with your payment, they will reduce it up to $50 a month. Now, if you owe $200,000, $300,000 in student loans, $50 is nothing, but it is something that they put in there as if it were some huge benefit. In my opinion, like you'd have to owe less than $5,000 or $6,000 for that to mean anything of significance, but it is something that technically exists. We're going to focus more on the interest subsidy so that you can have an understanding of what that may mean from a tax perspective and make the decision that's best for you. Remember that this new Trump budget bill did not extend the moratorium or the freeze on taxing forgiven student loans under income-driven repayment plan. So after the year 2025, if you have student loans forgiven under these plans, in the year of forgiveness, it's going to make it look like you earned that money when it came time to file your taxes. If you make $100,000 and you have $100,000 forgiven, you have to pay tax on $200,000 worth of forgiven student loans. And because you're not having that money taken out of your check to cover the taxes, let's say that you're in the 22% tax bracket. Well, you had your loans forgiven, but now you have a $22,000 tax bill that you have to deal with. As a result, it becomes even more important to kind of track how much could be forgiven so that you can save up enough money to pay for those taxes. And with old income-based repayment plan, if your payment is not making a dent on the interest that's growing on the loan, there's the potential that that balance could increase higher than it would increase under repayment assistance plan, where the government is covering all of that interest for you. So again, in my opinion, if it were me, and your strategy could be different, that's why I'm explaining this to you, I would still be looking at it and saying, I would rather figure out the taxes, even if they're a little more, than have to be paying all this money for 5 years longer. But I'm sure there are some scenarios that we just haven't run the numbers on where it may make sense to pay for 5 years longer and potentially have a lower tax bill, which is why it's really, really important that you have an individualized strategy when you owe a lot in federal student loans. Last couple elements of the plan that we'll mention is the fact that there is the ability to reduce the amount that you pay, even based on that percentage of adjusted gross income, based on two factors. The first of those factors being the number of dependents that you have on your tax return. So instead of using the federal poverty level, the repayment assistance plan, they will reduce your payment by $50 per dependent on your tax return. So if you had $100,000 adjusted gross income and you're paying 10% of your adjusted gross income towards your loans, well, that would be $10,000 a year. It would be $833 per month. But if you had two dependents on your tax return, you're going to be able to lower that payment by $100 down to $733 per month. If you have 6 dependents, it would be 6 times $50, so on and so forth. So that is kind of the replacement of federal poverty level. Is one of the first ways that you could reduce your payment, although there's not a lot of strategy involved with that as an option. The second is all strategy. You have to make sure that it's the right strategy. And that is as a result of the changes in the Senate, they did institute the ability to file married filing separately and have your spouse's income excluded under repayment assistance plan. So when you download the guide, if you have not already, you'll see that in addition to having the calculator for the plans themselves, we have also put a calculator for if you file your taxes married filing jointly versus married filing separately and the potential savings under those options. So I would encourage you, again, if you haven't already, to go to escapestudentloandebt.com/guide to download that guide. If you're listening to all this, like we've had several people in the past few weeks and realizing, man, this has changed so much, I need somebody to take a look at these things. If you're on our email list, you'll be able to sign up for an individual session, and we'll also put a link in the show notes so you can do so as well if you are interested. So this is a lot. It's going to definitely change some people's repayment strategies, especially if they're new borrowers after July 2026, and this is the only option available. But I do see some ways to kind of plan around it before that time. So make sure that you're tuning into these episodes as we release them, and we'll do the best we can to give you what you need to know to have your student loans forgiven, reduced, reorganized, or expedited. I'll see you soon.
From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.